Good morning. Welcome, everybody, to another Mindset Meets Mechanics session. Dave and I are here to talk about portfolio considerations, where we are going to not only talk about the public portfolios, we're also going to do the Learn to Trade Properly public portfolios as well. And we'll have some specific mention today, and it'll be a little bit of a carry-on, I suppose, from a continuation from what Dave did on Monday during the sessions, the LTTP sessions. Is that one of the objectives being reached, but it's not yet complete. But we'll get into that in a bit more detail in a moment. Before we do that, everything we cover here today is of general investment advice, and there's no specific investment advice. Right, real world portfolios, just background for those of you that are new. We're going to cover these three public portfolios and look at some of what's been happening, particularly with the Trump tariff turmoil, and our objectives are to really go through warts and all, be totally transparent about the journey of trading a trend following long only system, but a mechanical system through the financial markets with a view to do better than what we alternatively would do in other alternative investments, and to learn to manage and execute in the markets. And that covers not only the mechanical system, the timing, but also the mindset that goes along with it and the process. And it's all about executing under pressure with money at stake and finding out where the sweet spot is with what we can handle. And that's really the focus of the LTTPs, to start off small. It is, Gary. And
one of the examples that we use, the analogy, the metaphor, is this concept of learning to walk on the slack wire. So slack wire, for those of you who don't know, it's a ribbon, and it's about a couple of inches wide, and it's often you'll see them people in the park these days with these slack wires tied between the trees, and it's interesting if you go and watch them. Somebody who's just learning, and they put that slack wire an inch above the ground, and even though it's only an inch above the ground and they're learning, it wobbles like I don't know what. And this is really representative of us as individuals in the market, that when we go into the market, we are walking a slack wire. And for some of us, with the right approach, we have the experience where we, like in the park, we're doing it an inch above the ground. But for some of you out there, you might be doing it a meter or two above the ground, and it's going to have a completely different feeling to what it might be for somebody who is executing under pressure with money at stake, but at a managed risk level. And that's a massive difference.
Everything changes under pressure. Pressure changes everything, and it's all about taking the slack wire becomes a tightrope, which is obviously a bit more risky, needs higher degree of skill, and then you go higher up, and then as you go higher up, the process is exactly the same. There's no difference to the process, but the pressure changes your ability to be able to execute the process when there's more risk at stake, and that's what we're all about with the LTTPs. Right, what we're going to cover are the LTTPs. There's the 20th September one. There's also the 9th of December one. There's also the 9th of December is a US portfolio. The 3rd of February, there's an ASX and a US. And what I haven't put in here with the slide is there's also an April ASX and US, and we'll quickly have a look at those today, but we're going to cover these in the slides. Before we do that, what is the environment been over the last 4 or so years? And this is the S&P 500. Obviously, on the right-hand side of the chart over here, we've had the Trump tariff turmoil, and that dotted line there is where the close was, not in today's session, but yesterday's session. And that's showing that from that peak back here in 2021, that's 2022, September, is that January 2022, is the S&P 500 is up 12.7%, and the ASX is back into, we spoke about this discomfort zone, which I think I've still got on here. It's now 3 2/3 years. Why? Because we're back to where we were over here. So effectively, there's that sideways up and down market. So it was sideways with drawdown and falling, and now it's sideways, having had a breakout and come back into the range. So that this makes a difficult trading environment. It really does. And so that's now going that period of time. I was doing some research for the session, and I went back and looked at one of my go-to funds, and it's a hedge fund. It started in the mid-90s, ALH Man Financial. And the reason I've always used them as a go-to, I've been following them since probably about 15 years ago, or maybe the mid 2000s, about 10 years after that started. And during that secular bear market, they smashed it. They're 100% mechanical. They've been 100% mechanical with multiple systems, long, short, various asset classes, futures, equities, foreign exchange, the whole toot, right? And they don't disclose what they are now, but the early documentation to talk about having 35 odd mechanical systems going, but 100% mechanical. And I looked at I just got an updated view of their performance, and they don't look too dissimilar to that. They have struggled, for many years now, going on for about 12 years in the sideways moving markets, because they're in all markets around the world, not just the US market and including the Australian market, and they really have struggled in this environment. I'll make that as a point because they are a go-to. Right, let's just look at some ASX. Or did I miss a slide there? No, I didn't. Okay, so looking at the ASX, the ASX public portfolio, I've got this going back to the 5th of August, and I picked a trough, if you like, to see how the portfolio, the public portfolio, had gone relative to the indices. The red line is the ASX 200 accumulation index. So obviously I've suffered some drawdown as well as our equity curve, but we're running at over 14%, 14.5%. And that's, annualized doesn't matter because it's less than a year, compared to the accumulation index running at 4.4. So it's been tough, but there has been some outperformance over that relatively short period of time. Over the longer period, it's 173% growth compared to 112%. So there's still 3% compounded percentage points outperformance there. And sure, we've had a tough period through here, which I've just shown you the equity curve, if you like, of the ASX 200, and that's reflected in the portfolio. So a lot of these gains. So there's the ASX 200 without dividends. It's just basically the chart we looked at. Yeah. So all of this growth has effectively only been dividends, and Australia's benefited from about 4.5% yield is where the benefits come from. Yeah. So in this environment, I was talking to a friend yesterday who's big into ETFs and has done pretty well in this environment because he's reinvesting dividends. Well, he had one that he's reinvesting dividends, the other one he didn't sign up a DRP, and that's effectively just gone sideways. And I was just talking him through what that all meant. And he said, well, he's going to now go more into dividend reinvesting, and so he can get the benefit of long-term ETF. He has about a 10 to 15 year outlook, and you'd never heard of a secular bear market. So we had a discussion around that, and I didn't want to put all the fear into him, but basically it's what we as active investors, or even investors, and if you passive investors, probably more so, have just got to be mindful of. At some stage, the secular bear market's going to start sometime in the next 1 to probably 7-8 years maximum. And then buy and holding ETFs will not be the go.
Yeah, this is what we often refer to as sequence of returns risk, Aaron. We don't know, when the secular bear market is going to happen, the degrees or the depth of how nasty it's going to be, whether it's going to be short and shallow, whether it's going to be long and drawn out. We just don't know. And so one of the things we learned through LTTP and getting everybody on the same understanding is that as we go through life, we have different stages, and sequence of returns risk, if you are 20 or 30, really isn't an issue. So when that big bear market happens, so if we have a 2008 or a 2000 or a 1929 or whatever it may be, or a Japan type situation, depending on your age, really does matter. And for most of our members, they tend to be in stage 2 or 3. Stage 2 is really sort of 55 to 65 years of age. Stage 3 is the second longest stage, actually, because that's from your retirement through to when we push up daisies ultimately, and hopefully for many of us it's it's 25, 30 years. So if you're about to retire and we do hit a sequence of returns risk event that has a big impact on a buy and hold ETF strategy like your friend's got, that's really going to hurt. And so, using different language sometimes, and secular bear market for some people might think, well, that sounds a bit highfalutin, etc. The idea of sequence of returns risk, that big fall can have is a simpler concept that sometimes, maybe introducing that to him might be something that he'd understand.
And that's what we spoke about, the fact that his horizon, his investing horizon, is going to end at some stage. It's probably going to be smack in the middle of the next secular bear market. And so the propensity for him just to hold through that, which he still has to have the psychology to be able to do. But even if he did, that period's going to run into a period of time where he's going to start drawing that capital down, and it's not going to have enough time to come out of drawdown and make a new breakout into a new secular bull market, which is decades away, the start of the next one, that is. So that's just something to be mindful of when you do your core satellite asset allocation and strategy allocation. Yeah. Right, keep on going. This is US relative performance looking June 2024 to current. So that's relatively short period of time, 10 months. Even though we've had the drawdown, there's still outperformance over that period of time. Looking at another time frame going back to September 2022, outperformed most of the time, but the US portfolio has been hit a bit more than the Australian portfolio and a bit more than the index over this period of time, and roughly the same performance over the last 2.5 years of the S&P 500 total return index, which has really been a tough index to match over the last 3 or 4 years. Even Warren Buffett struggled for a period of time there, although he's done a lot better in recent times. And that's the equity curve since inception. We're sitting, and the drawdown we've had just recently has dropped the differentiation from about a 0.4% compounded percentage points or annualized return difference to nearly 2%. So that's going to happen. And but we've got to keep going through this and keep actively investing. Our primary aim here always is the next, when the secular bear market does start, it's going to probably look something similar to this, except the index is going to keep going. And we don't know how the first section down or the first leg down is going to look like, how quick it's going to be. This was quick, and you'll see some of the lost trades in a moment. But it's the other starts to secular bear markets have actually been quite slow and drawn out, and plenty of time and exit signals and all that to happen on a much shallower, steadier time frame. Whereas this has been sharp. This is 1987 COVID type feeling. Neither of which happened in a secular bear market. They both happened in secular bull markets. So we've had steeper falls in secular bull markets than what we've had in secular bear market. Or quick ones is really what I'm talking about, rapid ones. So we don't know what it's going to look and feel like. It's definitely going to be drawdown, and we still don't know at this stage. The jury's still out, because we have to make a new equity high to really render this retracement over, and we're still in the middle of it at the moment. So these are the tough times to be able to keep executing and properly, and to do it, as Mark Douglas said, to execute flawlessly.
Yeah, particularly if you haven't learned, to walk that tightrope, that slack wire at a low level. If you're doing this at a high level, then it's really going to be quite challenging.
Correct. Yeah. Because ultimately, there's percentages, but ultimately the absolute dollars are the ones that make the difference in the end, or to how we feel. Yeah. Quickly, the just looking at some relative performance on the leveraged portfolio, it's had a 50% drawdown. So these are the drawdowns along the way since September 2022. Still, about 3 times outperformance in percentage terms compared to the total return index. But this is what leverage can do. It's sure you can get the growth on the upside, but drawdown can be like it. And this is what we're working on still, to try and minimize these drawdowns, bring in market risk in different ways of being able to reduce that. So when we have cracked that, and it's probably a good time, given where we are in our research and what we're doing, to bring in some new ideas and slightly different ideas to what we've been researching, to see how we can have some real live drawdown that we got to work with to be able to improve that in some way. Right, sales over the last month. There's a big one in mineral resources. This was spoken about last week in the mindset the session we had on market status. So that closed out at a 33% loss. We had Santos also. So these happened. These entries were just before the 31st of March and 26th of March, and were closed out in that week of the tariff turmoil. So some big losses there. And that's obviously what's led to drawdown. They're closed out, and now we've got to see where those trades go. In the US, even bigger. So look at these, were opened in February and March, relatively short hold periods. There's a longer one over there that obviously RTX had a bit of time to rise. But these are, as individual percentage loss trades, are about 2 to 3 times bigger than what the average is over the long term, which is indicative of the kind of market that we've just recently had. So so we don't want to hide away from these. We've got to be transparent and open about these, talk about them, and just show what can happen both on the downside and the upside. And to show you the difference between the upside and the downside, let's just have a look at leverage. So that's the slide that I put up last month, a month ago, of the trades that were closed out, and these all happened in these early March. There's no indication at this stage that there was going to be a tariff turmoil, a few days of massive falls, but they were coming, right? And so these were running, getting a bit. You can see the trends over here. We're getting quite long. They've been going for some time, and now this is this month's sales exits that we've had in the last 4 weeks. So so you can see some big percentages there. About a little bit less than double the average. That's double the average. I think the average on the US is around about 9%. On Australia, it's about 7%. So some big loss trades over there, percentage loss trades there, and obviously the dollar-wise in a leveraged environment were much bigger than normal. Obviously, going along with the percentage. Yep. Now sales. So in the LTTP, the ASX, the September one that we started back then. Yep. There were some big loss trades too.
Yeah, absolutely. And, anything can happen in the market, can't it, Gary? And, and I think this is what, these sorts of experiences, whilst nobody likes to have a loss, learning to deal with the losses and having a very much anything can happen, I don't need to know what happened type of mindset enables us to weather these types of events when they occur, because there's always going to be, you've talked for years, Gary, about all these different variables. There's always going to be another variable out there, an unknown, and then this little Trump episode at the moment is just one of those. And we never know what the impact of these is going to be either, and so trying to work out what the upside or downside might be is really something just a never-ending waste of time at the end of the day. So when we look at this particular portfolio, the one back in September, it's actually had a little bit of run up before we went into a serious part of drawdown. I think the deepest amount of drawdown that we had in getting that run up, the little down bits, etc., was around about 5 or 6%. So that was really only a tiny little vibration on the slack wire. Whereas as seeing some of these at the moment with this particular portfolio, we still haven't quite reached that sort of 15% drawdown level that we think about in terms of skills acquisition. But, the nice thing that members are reporting back to me is that now, David, I'm not worried about taking new trades. The way that the mind shift has occurred over, through the training, but them taking ownership of the way they're thinking, it's changed their whole, thoughts about what they're doing in the markets now.
There've been some really unbelievable, almost like confessions, but real, genuine, statements of where people are with their journey, their trading journey, and how much they've learned. In the few weeks or months that they've been in the LTTP.
Yeah, 100%. Because when you see an individual loss trade of 32% or 22%, for somebody who's not skilled and hasn't yet been able to transform the way they think about the markets, that is potentially a big showstopper. And automatically, the fear, increases, the doubt, the hesitation, and then all of a sudden they jump out of the market. They remove themselves from the flow that we talk about.
Yeah. Which in one of the first steps that when you really pull Mark Douglas's material apart, and he talks about the different steps, and it's all there in the book, is the very first step to take to on the path to achieve consistency is acceptance of risk, and the degree to which you do not accept individual loss trades or a number of loss trades or drawdown is the degree to which you'll never get to or minimizes the probability, reduces the probability of actually achieving consistency. So the very, very, very first step, and it's all over. You can just read the forward and chapter 1 of Mark's book, and just look for the number of times he talks about acceptance of risk in that first chapter, and it is massive. It is huge. Which really means that to accept risk, it means that how do you know you've accepted it? Well, you've maintained a neutral mindset, but most importantly, as Dave said, is you continue to stay in the flow. And what is your flow? Your flow is your edge. If you think you know, you're out of the flow. If you think you don't know, or if you know you don't know, you stay in the flow. But it's that acceptance. So what is the manifestation of acceptance of risk? It's continuing to execute your edge flawlessly. And you can find that quote's not mine, it's Mark Douglas's. And to do it is, and the first time you go through it, it's not going to be effortless. It's going to require discipline. So discipline is a technique to as a stepping stone technique to get to effortless. That when you get to effortless, you'll know, because these events do not affect you. And then the degree to which they don't affect you is the degree to which you have accepted the risks of the market. And the main one being is loss. Human beings just hate dealing with loss. So we can compartmentalize loss. It doesn't mean that you're going to, if you accept loss here, that you won't accept it that you will accept it for a different or the same kind of degree for your football team or whatever. I know mine's 5 zip. And that's losses, or zip 5. But that's the mindset we've got to get to. That's where we've got to get to, accepting the risks. Okay, just keeping going. I've got a red box around these because this now is the US LTTP, and the reason I've got these is these percentages are big, right? I mean, that one there is 3 times. Lam Research is 3 times the average loss. But the total loss to the portfolio was $556.
Yeah.
So that's slack wire close to the ground.
Very close to the ground. And that's deliberately, that's on purpose. And we need to create this environment where we feel the pressures, to face the breeze, so to speak. And we do that by allocating an amount of funds that's going to give us those emotions, but not the emotions that are going to make us, sleepless at night, thinking, my God, what have I done? I can't tell my wife. This is my future. Whatever your individual circumstances are, we need to be sensible about this, Gary. And that's why we suggest, maybe it's only 5% of your total available capital. Have some skin in the game, because we need, as developing, burgeoning traders, to learn how to trade properly in all market conditions. Well, this portfolio is experiencing all market conditions. Right. In fact, it probably actually hasn't yet, because we haven't really had much of a rise in the portfolio at all. So we've learned, we use the analogy of driving a car. Well, we've just got our license and we're out there driving, and we've just driven out from the license testing place. Or maybe we haven't got our license yet. We've still got mum and dad sitting with us, and the sun's disappeared, the clouds have come over, it is poor, it is hailing. We're in the middle of peak hour traffic. There's a collision ahead of us. There's cars tooting everywhere. What are we going to do? Are we going to, remain calm and logical and rational about what's all happening? Or are we going to throw the keys to mum and dad, said, no, that's it, I'm out of here, never going to drive the car again? So we are, as part of this process, we have to look forward to these conditions, because this is how we're going to grow. This is how we're going to test our mental capacities, our state of mind. And Mark Douglas sets up the framework for that, and really the how to habitualize this, to systemize the way that we're thinking, is the work of James Clear. And, those 2 books, I think they're the only 2 books that you ever need in terms of, thinking about the markets and creating good habitual thinking processes.
Absolutely. Just about every other book on market psychology or execution, or people that have been trading the market for years, are just really different ways of regurgitating or saying the same thing in a slightly different way. But effectively, it comes down to just this. There's nothing else to learn, really. There isn't anything. It's a habit. It's about, it's almost like a habit forming, a habit developing system, but doing it, developing the habits and developing the skills with little risk on the line. And I know you talk about the analogy with the motor car where people have just driven out and got their license, but that conjures up a time period, a period of time as to how long you've had your license, right? And driving is one of those things that the longer you drive, the more experience you get, the more conditions you experience, et cetera, et cetera. And there are similarities there with trading, but we've had people confess to us just really in the last 6-7 months, that they've been doing this for over 15 years, one over 30 years, and that they've only really, having done this now, really felt like and know and are confident that they have the skills and that they thought they had in the past, but evidently their results showed that they didn't when we got into market conditions like this. So it's how sweaty are the armpits, how sweaty are the palms of your hands, how sweaty is the upper lip when you're going through it. These are all manifestations of degrees to acceptance of risk. And what are you saying? What are you thinking? What are you feeling? What are you doing when these situations come? So we smack in the middle of a really, really good learning environment right now. And Dave says, look forward. We've got to embrace these. We've got to look forward to it. And we'll come to the slide in a moment where we'll talk some more about that. But so this is the February ASX and USA. Again, the box there is just showing so we can see similar the same trades as what we've had in the public portfolio. So we won't dwell on this anymore. But those are small, absolute dollar losses. So we're close to the ground.
Yeah. And if you think, and this is on around about a $30,000 value portfolio. If you imagine if you were doing it with 10 times the amount, well, those loss figures are 10 times the amount. That could be something that would take, people who are not skilled out of the flow. That's it. I've had enough. Yeah. This is silly, blah, blah, blah.
That's it. Okay. And then they stay in drawdown because the real thing, we haven't got to the main point yet at the moment, which is this. So I've just taken the slide straight out of, I think it's session number 5 in the mindset or the foundational training, which is now part of the quick start that Dave's created and part of the process and mindset training intensive. And effectively what it's saying is that we want to execute, we're using Sparse Investor, but it could be your chosen mechanical, it has to be 100% mechanical, to actively manage stocks through portfolios, through 2 portfolio drawdown periods of at least 10%, but preferably minus 15%. So condition 1 of the skills objective is just being reached now. So we're in it. So bang, this is what we set out to do. And we didn't know how long it was going to take. It could have happened, well, for the people that started in April, it's kind of, well, it hasn't really because they had not invested enough, but certainly the people in February have got straight into it that started the LTTP in February, but it's taken all this time for the people that started in September and December to get to it. So that's the first part. But the second part is that you've got to actually trade out of this. Yeah. And that's the important bit. So the learning, the acceptance of risk happens in the first part where we actually get into drawdown, and now we're learning how accepting we are of the risks in the market. And the second part is where you start with the objectivity. This is which is a second step to consistency. The third step is trust. Fourth step is confidence. And the fifth step is actually consistency itself, right? So now we are getting into that this is really the tough bit. This is where the learning happens, right? And we're not only going to do that once, we're going to do it twice. And that's how the skills grow. Why? Because we're growing Myelin. Okay, this is a quote from Daniel Coyle, the Talent Code, and we're tying it in because Dave spoke about this on Monday. Yeah,
I spoke about this on Monday. I had a lovely email from one of the members doing LTTP, and it had real meaning in her own world, and that's how we learn. We apply our own experiences on what's being presented, and this concept of Myelin. I did my best to explain it. I'm not an electrician, but visualize. Bear with me that our brain is. We talk about the wiring of our brain, and we're talking about neurons and things like that at a very microscopic level. But we can think about it as being a bit like electrical circuits in your house. And if you don't want a fire to start in your house, it's really important that all those wires in your house, they're insulated from each other. They've got a protective coating around them, Gary, and that stops the circuits from short circuiting and sparking and creating all sorts of issues in your home. And it's the same in our brain. Our neurons have this coating that we can develop through learning. We can develop finer coating through practicing of skills and repetition. We can do it through diet and exercise and sleep. There's all sorts of things that can have an impact on this myelination that we call it, the protecting of those nerve fibers and actually growing stronger neural pathways so that the messages flow better. And that's the whole process of, of myelination and what Daniel was talking about in the talent code.
Absolutely. So this is the real thing. For those of you who aren't familiar with this, you might be familiar with the word myelin in terms of electrical circuitry and wiring and that sort of thing, but it's also a biological term. So it's a sheath that runs around, our neural pathways in our brain. And the stronger, the more you practice a skill and the more adept you become at that skill, your brain actually grows the myelin to be thicker. So the sheath becomes thicker and locks in those neural pathways. And that's skill, whether it's physical or mental. And that's what we are doing. And we are smack in the middle right now of starting to grow that myelin around the circuitry that's developing in your brain, which is developing your skill either for the first time or strengthening it as you go through this. And I've spent the business is nearly 30 years old, so you can imagine how many discussions I've had with people, the big mistakes they've made and how they couldn't stop themselves doing it. So your neural pathways are in control. That's your subconscious, right? And they haven't been able to take exits, and no matter how hard they try, they haven't been able to until they've been put into an intentional, deliberate environment where they make a commitment, to start at a slack wire and then grow these skills so that they can then go further and further off the ground, take more risk and do it with more money. So it's skills acquisition first before, you go and do this for the real game. The real game is doing it for profit and growth. But we have to get those skills first. Otherwise, you're just going to self-sabotage yourself when that set of circumstances comes around that your circuitry can't handle. Your subconscious will always do your bidding. It'll override your conscious mind.
Yeah. And there's a great recent example out in the sports world, Gary. You're probably the best one to talk about this in the Masters tournament where I think it was Rory McIlroy, highly skilled professional, in the last couple of holes, hit one into the water. Okay, so made a mistake. And yet the very next shot, or the hole after that, was in a position where all this pressure on himself, he could see the title going away. Imagine what that would feel like. And yet was able to cast everything aside and execute probably the most perfect shot under those conditions. How many times he must have practiced and put himself in that, and his coach and his caddy saying, right, on the practice fairway, this is going to win you the Masters or not, and stepping up to the mark and actually executing at that point
under
in
pressure,
time.
under massive pressure. And that's physical skill. Yeah. So, and there's no difference to mental skill as well. Yeah. Okay, so just one other point I wanted to make here to finish that, and then we'll quickly look at some portfolios, the other LTTP portfolios. We'll get to those pretty quickly, and then we'll finish up. Right, so this is the ASX public portfolio. There's the blue line. And this here is what's called an underwater curve. It's called Drawdown, and you can plot this in all your portfolios. It's only relevant to portfolios, not to stocks. Although I haven't tried plotting it on a stock, maybe you can. And what I've drawn here are two black lines. The one is a minus 10% drawdown, and the other one's a minus 15. So we're talking about getting into that zone for it to be, and that's really an arbitrary number to say that there's sufficient risk happening here and draw down in our money that it's going to start challenging us to still stay in the flow. That's why we've chosen it. So now we've got to come out of that. And I just wanted to point out that the number of times that this portfolio over the 9 and a bit years has actually got to below 10% drawdown, right? And even below 15% drawdown. So when it bumps its head along the top, that's a zero line there. And every time it hits that, it's making a new equity high. So this underwater curve is good for understanding how often you've gone into that and how often you've traded out of it. Now, most people look at that, unskilled mind look at it and go, oh, I don't want the -10, the -15, even the -22% over here. Whereas the skilled mind will look at this and go, wow, look at all the times I made a new equity peak.
Yep.
I've come out of it. Yep. And this is what we want your portfolios to get to, because you can't come out of drawdown unless you continue to stay in the flow and execute your edge flawlessly to come out of drawdown. It's the only way it can happen. So I think we've said enough, quite a lot about that, but these are just pictures to conjure up in your mind to show that we're in skills acquisition right now to come out of drawdown. That's what we've got to do. Okay, just quickly, so you were talking about the September LTTP, and there's the drawdown. Yep. So the grey line is the drawdown, and what's that, minus 15 point,
minus
15.47?
13.7. So we're between that 10 and 15 at the moment. So we could tick that and say, look, that's the first milestone achieved. It's an environment that we have to be able to experience. So this is where the growth occurs. This is where we get to test our skills. And actual fact, it reminded me of one of the earlier charts that you brought up, Gary, that you were showing the public portfolio. And I was looking back from September, August, and the shape of the public portfolio is very, very similar to the shape of this particular equity curve. And, you know, the members that are running that portfolio are doing exactly the same process as what you're doing in running the public portfolio. So we have different public portfolios, and you're creating your own public portfolio. I think it's brilliant.
So the task at hand now to finish the first skills objective is to come out of drawdown. So we've started, there's a little bit of a tick up over here, and we've got to take out that new high. When that new high is taken out, that's the first occurrence of trading through a drawdown and rising to a new equity peak.
Correct.
The Myelin will be growing.
Yep.
And so this is the US, was started 9th of December. Now, this obviously, you can see the fact that was flatlining over there was because we weren't fully exposed to the market. Yeah,
that's right. Yeah. And since then, you know, we've had the Trump variable, call it what you like, and we've had to face some drawdown there of 20%. So, you know, it's getting to that, you know, that deeper level, and we don't know how long it's just going to go for. The challenge for this portfolio and the members with it is that it really didn't have much in the way of growth in that portfolio before hitting drawdown. And that's not unusual, because oftentimes when we start a portfolio, we know that the methodology cuts losses early, lets winning trades run. So one of the skills that needs to be developed is letting trades run. And I think, you know, members when they first start off are comfortable taking some short losses if they're not too big. And a couple of big ones, as we've pointed out, can be challenging. The flip side of that is that we've got to have the right mindset that we're patient, okay, and that we let those trades run, because there is a big temptation along the way to say, look, I've got some green. Imagine getting, you know, that worm goes back up to that, you know, where that dotted line is at the top, to say, all right, I'm back to square one. I'm going to jump out of the market now. I've had my experience. That's enough. You would think, well, what was the purpose of the exercise, really?
Wouldn't have learned anything.
Wouldn't have learned anything at all. So this is the environment that it is tough, but we've got to face up to the realities that's just what the market does.
It's acceptance of risk.
Correct.
Yeah. And then we've got the February one. So this started as February ASX. So that's got into what?
It's about 12%.
11.96.
Yeah, so not quite as steep as the other portfolio. Yeah. That's in the Australian market.
Start of February. And the US market a bit deeper, 21%.
Yeah, that's right. So that's just two portfolios started off exactly the same date in different markets. And, you know, the US market typically is a bit more volatile than the Australian market. But that's what gives rise to the growth of the market over the longer term in any case. So, you know, again, it comes to acceptance of risk, etc. But, you know, for people that are starting off their portfolios, this is a big challenge for them. And that's why it's so important to create the environment with that slack wire, you know, an inch above the ground. We're not doing this 10 meters up in the air. You can imagine if you were, what would you be feeling right now? Okay, particularly if you didn't have any mental framework to process and conceptualize what's going on, and very difficult.
So typical thoughts people would have now if they weren't in a if you like an intentional study group, and they were just on their own. What would they be thinking? They'd be thinking, well, why did I start then?
Exactly.
What could I have looked for? Yeah, let's go back to the December. What could I have looked for that would have got me out of the market before that happened, and I would have saved all of this drawdown? And then and these are the thoughts that abound. And then what do? They end up going down, the path of trying to analyze away this pain, right?
Yeah.
So, which will never happen, because every single methodology goes into drawdown at some stage, and to a greater degree than what you expected would do. And then so all you're doing is delaying the inevitable drawdown that's going to happen with every single methodology that there is. And what you're not doing is taking the opportunity to build the skills to be able to accept the risk, to be objective, to stay in the flow, to really get your subconscious mind in sync with the way that the market operates, to become empathetic with the way the market operates, to be on the same side of the fence as how the market operates. And the longer you delay that, the higher the probability is that you're just not going to get it, or it's going to be more difficult to get it. So living through the drawdown, getting the feeling of going into it, getting the feeling of coming out of it, which is more important, is really what this is all about in learning to trade properly. Okay. That's as much as we had to say today. I'm not going to go into beyond charts today, because we've effectively covered all the portfolios here. There are 2 April ones, which are probably too new. The equity curves, you're not going to learn anything more from those equity curves.
One of them went flat for about 3 weeks, and that's purely because there weren't any trades coming up.
That's right. That's right. So nothing more, but I think we've made the point. Are there any questions? Bruce is saying 2 cycles of 10 to 15% drawdown followed by new highs, likely to take several years. Not necessarily, but it's a good point though, Bruce, is that at some stage, and you've got to be able to look yourself in the mirror and be honest with yourself that you believe you've got the skills. And whether you do go through that second trading through, down and through and up into a new equity peak of a second drawdown with the capital that you're using in the Learn to Trade Properly study group environment, or whether you do that with your own money somewhere else with a little bit more whatever, so you move from skills acquisition plan to investment plan, where you're moving from trading to gain skill to trading to gain profit, is up to you. We're not going to be prescriptive and say, hey, this is, you will do it this way. You will know where you are, because a lot of the people, our members that are doing these have been trading for many years. And the light bulbs are just going off, boom, 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 all the time. And they're being able to relate, because this is not their first time they've gone through drawdown. They're comparing it to the previous times they've gone through, and they're able to make that comparison and say, I see what I did last time, and I see what I'm doing now. I've got this, or I've got it to sufficient degree that I'm going to be able to take the slack wire further off the ground, and that's fine. Only you will know that, but there'll be others that don't have that, and will come out of this and still have questions, and still won't have. They might have some degree of acceptance of risk, but will the objectivity be there, i.e. the flow, staying in the flow? Will they still be expecting, to what degree will they be expecting profits at the subconscious level, even though at the conscious level they know that not every trade is going to be a profit trade, and they'll still be struggling with those. And so you need to go through another one of those. I'm speaking to a member who's been a member for over 20 years, and he doesn't get this, because he doesn't get how people don't get this. And I say, well, hang on, you've been through all this with your real money, and this particular gentleman's got well over $3 million invested in US and Australian SPA 3 investor portfolios, and he's struggling because it's such a long time ago. He's struggling. He can't remember what it was like to go through at the beginning, in the same way, the same degree that people who are going through it for the first or second time. He has some inkling of it, but it's such a long time ago, and he's overcome all those dysfunctional beliefs. He's overcome all those, the association with the past that Mark Douglas talks about that was so painful that it just took them out of the process. he's forgotten all that. He's moved on. He's created new neural pathways, and the myelin the sheaths have got so thick around there that it's just ho hum and off he goes. And that's where we're trying to get our customers to, but in a far quicker way than what it took this particular individual to do, right? So Nick's saying surrender to the process. Stephen's saying very interesting, guys, learning lots. You're totally right. Sorry, it's very light grey.
Totally right about habits and mindset. It's just about trusting the process.
Correct. Thanks, Stephen. Let's change. Let's make that a black font. Well, if there are no other questions or comments, thank you for your time. Hopefully we got the mark. We got the points across. I suspect that in a month's time, we're either going to still be in this environment and experiencing, emotional pain to various degrees, and how we are handling that, what we're thinking, feeling, saying, and doing. Because all of those in the Learn to Trade Properly study groups will be journaling that, because that's learning. That's learning. Or we may have come out of the drawdown and be sitting at new equity highs, but we'll wait and see in the next session. So thanks for your time.
Yep.
As always, we wish you consistent, objective, and peaceful active investing.